two of the most common areas this year where we're seeing a lot of interest from investors is looking at gold exposure and also looking at Bitcoin exposure.
Lately, we've been hearing the same question from investors of all stripes. What else can help diversify my portfolio now?
This era of access and integration is what's here for Bitcoin now.
Gold ETFs, where when you buy that ETF, you know that your ETF is backed by gold, which is in a vault in New York or London. That has risen in the past few decades, and that has given everyone access to storing gold. You can buy an ETF that gives you access to gold and do it in a very liquid and very efficient manner.
After a cycle of sticky inflation, shifting interest rates, and geopolitical uncertainty, two assets keep coming up: gold and Bitcoin. One is elemental, mined, and familiar. The other is digital, decentralized, and still new for many. Both are scarce, both sit outside the traditional stock and bond mix, and both are getting renewed attention as investors rethink where to find resilience. Welcome to The Bit, where we break down what's happening in the markets and explore the forces changing the economy and finance. Today, we're looking back on some key conversations from past Bit episodes so we can answer two practical questions: why these assets are popular again now, and what investors should consider if they want to use them as diversifiers. We'll hear from Gargi Pal-Chaudhry on gold's enduring role, from Robbie Michnick and Samara Cohen on the evolution of Bitcoin and investor access, and from Jay Jacobs on how both can fit in a portfolio alongside traditional holdings. Think of this episode as a guided tour of these two assets, from why they matter to how to think about them in a portfolio. I'm your tour guide and host, Oscar Pulido.
You ask an important question around the history of gold, and I think 2,000-3,000 years ago, gold was still very much a medium of exchange. It was a store of value, an artifact of beauty. More recently, if you look back to about 700 BC, that's when we were really thinking about gold as a medium of exchange, a medium of payment.
Gold tends to come back into focus when the world feels a little less predictable. Part of that is history. It's been a store of value across cultures and across cycles. But what specifically puts it in the spotlight today? If you're looking at portfolios through a risk lens, think about three broad forces: the trajectory of economic growth, the state of geopolitics, and the path of interest rates. When those three are in flux, investors often want something that has historically behaved differently from stocks and at times from bonds as well. Gargi Pal-Chaudhry, Chief Investment and Portfolio Strategist, lays out this checklist.
I think it's important to think about why we as investors gravitate towards gold, but why is it gold? So number one, there is a lot of concern around economic growth.
Another down day for Wall Street on concern that the market has outpaced the prospects for economic growth.
And historically, we have found when there are periods of concern around the future of global growth, investors have turned to assets like gold, which are likely to be a good diversifier to traditional investments such as equities, such as bonds. Number two, I think geopolitical fragmentation, geopolitical risks.
We have policy uncertainty from all angles. It's really been off the charts.
So I do think this geopolitical risk that arose, and actually, frankly, concerns around more geopolitical risks that might abound, is another reason that investors are thinking about gold as an alternative.
There's also a more technical point that matters for gold: real interest rates, the inflation-adjusted yield an investor can earn in the market. Gold doesn't pay a coupon or a dividend, so when real rates are rising, income-producing assets can look relatively more attractive. But when the market expects real rates to stabilize or move lower, the relative trade-off shifts, and the case for holding a non-yielding diversifier can get stronger.
We talk about the path of interest rates, and particularly it's the path of real interest rates, so inflation adjusted interest rates. Remembering that while gold bangles are beautiful and while gold can be stored in a vault for centuries, it still doesn't have a yield. So when you buy a bond, you have an income associated with it. You have a coupon associated with it. When you buy a stock, you might earn some dividends associated with it. Gold does not have that. It's a non-yielding asset. So in a world, if interest rates are moving higher, you can gravitate towards the bond markets to earn that higher interest rates. You might not be as attracted to gold. But in a world where you expect interest rates to move lower or remain stable, if you expect real interest rates, so that inflation-adjusted interest rates to move lower, investors could find gold more attractive in those moments.
Another important lever that investors watch is the US dollar. Historically, gold and the dollar have often moved in opposite directions, as has been the case this year in 2025. It's also key to observe what large reserve holders, like central banks, are doing with their balance sheets. Central banks don't make decisions for short-term trading reasons. They move slowly, with big-picture motives. When that community is adding to gold reserves as part of a long-run diversification plan, it can reinforce gold's role as a monetary anchor outside the fiat system.
Historically, the dollar and gold has had a negative correlation. So again, if your expectation are for the dollar to decline or even just not to increase anymore, that could be another powerful dynamic for adding gold to a portfolio. But for all of the things that I mentioned, I think two that are probably in the forefront of investors' minds right now are, number one, this diversification away from the dollar. And we've seen many central banks, especially in the emerging markets, such as China, India, Russia, that have been adding to their gold reserves to diversify away from the dollar. And then the second one is this fear of a geopolitical event or a global growth slowdown that is driving this current moment and this current price action.
But before we shift to Bitcoin, it's worth clearing up a common misconception around gold and inflation. Investors often call gold an inflation hedge, but the historical record is more nuanced. What's been more consistent is gold's behavior when real rates fall, including in stagflationary environments.
There was one period of time in the 70s, very specifically in the early 70s, where inflation, as we know, was in the double digits, and when gold was a hedge. Outside of that, though, no other period of high or very high inflation has actually resulted in gold being a good hedge. What it has been is not so much an inflation hedge, but a hedge where more of a stagflation hedge, actually, where again, if you expect real interest rates to go lower, which you would in a stagflationary environment, that's when it has actually worked as a better hedge.
And crucially, access has changed. You no longer need vaults or bars. Modern vehicles have brought gold into everyday portfolios with transparency and liquidity.
The rise of gold ETFs, where when you buy that ETF, you know that your ETF is backed by gold, which is in a vault in New York or London. That has risen in the past few decades, and that has given everyone access to storing gold. You can buy an ETF that gives you access to gold and do it in a very liquid and very efficient manner.
So if gold is the archetype for physical scarcity, Bitcoin is the experiment in digital scarcity. It's also an experiment in access, moving something of value across a network with no central gatekeeper. For some investors, that's the attraction. It's global, programmable, and intentionally limited in supply. For others, the newness, the volatility, and the different operational considerations create a steep learning curve with too much inherent risk. To set a foundation, let's define the landscape and where Bitcoin sits within it. Here's Robbie Michnick, head of digital assets at BlackRock.
Digital assets, as the starting point, is the umbrella term for this space. And everything in digital assets is enabled by blockchain as the underlying technology. And within digital assets, you've got really three buckets that we think of. One is crypto. The second bucket, stable coins. The third bucket, tokenized assets.
But it's worth asking the question, what problem is Bitcoin attempting to solve? Consider the friction in moving money across borders. The delays, the fees, the string of intermediaries. Now imagine an asset that can move globally on a shared ledger, nearly in real time. That doesn't answer every question about volatility or value, but it does explain some of the design choices and a lot of the interest.
The first is payments, and particularly cross-border payments, or moving money across political jurisdictions. That has always been difficult. Domestic payments today, actually pretty easy, pretty efficient. A lot of countries have real-time digital payment networks, but cross-border is another story altogether. If we go back a millennia to what was a very pioneering system in the Middle East, the Hawala system, that was how money moved across longer distances in that time. And how it worked was you went to a broker and you deposited something of value. They created a receipt that was then transmitted to another broker, let's say in the next village, who was connected to your broker. And they would pay out to some recipient something of value. And then the two brokers would periodically settle. But in fact, our cross-border payment system today looks a lot like that. When we think about the introduction of Bitcoin and digital assets, this idea of being able to move a digitally native asset globally across borders in near real time at near zero cost, that's an amazing breakthrough.
At the core is engineered scarcity and open access. The idea that anyone with a smartphone and an internet connection can hold the same asset with a mathematically capped supply.
Bitcoin, with its rigidly fixed supply cap of 21 million units, 19.5 million of which are already in existence, has a totally different paradigm. The ability for the first time to have an asset that is truly global, that anyone with a mobile phone and an internet connection can tap into.
But while Bitcoin can seem like an attractive opportunity for investors, it's worth noting the roller coaster path it's been on. It's no secret that Bitcoin has been volatile. History shows dramatic booms and equally dramatic drawdowns.
There have been spectacular bull markets and spectacular bear markets in this industry's short history. Bitcoin was created in 2009. And then you have 2010, 2011, the spectacular parabolic rally when it goes from nothing to something, then crash.
Cryptocurrencies went on a wild ride today, wiping out recent gains before recovering.
2013, another parabolic rally.
Mt. Gox, the one-time largest Bitcoin exchange, was forced to file for bankruptcy.
2017 arrives, hits all-time highs, order of magnitude above where it had ever been before. Again, that rally collapses. The fourth cycle, which we saw starting in COVID, that too collapsed in 2022 with some excesses and other bad behavior. Each of these cycles tend to be a multiple or even an order of magnitude or more higher than the prior cycle.
One reason interest has broadened is access. More familiar wrappers, more institutional-grade infrastructure, and clearer ways to view crypto alongside a whole portfolio rather than in a silo. Here's Samara Cohen, Global Head of Market Development for BlackRock and formerly the Chief Investment Officer of ETF and Index Investments.
This era of access and integration is what's here for Bitcoin now. So it's going to be critical to see how the integration of Bitcoin in capital markets catalyzes new strategies for investors and differentiated outcomes. When you look to invest in and own Bitcoin directly, as an investor, you're engaging with an entirely new ecosystem. You have to take a more direct role in vendor selection and onboarding. You need to understand custody and also the differences in tax management. This is a big education curve, and it introduces complexity as well as potentially trading and operational costs. So that's the state of play for investors who are alongside their asset classes and markets they have traditionally been invested in, looking to overlay Bitcoin strategies. Now, the attributes of digital assets that we've talked about are actually particularly appealing to millennial and Gen Z investors who, over the past several years, are becoming much more predominant in the investing world. And that's an important part of what's happening in market structure around the world and what's happening in crypto. Both of these generations are digital natives. They grew up with the internet. They're comfortable transacting their lives in an increasingly borderless space. And they are more likely to own crypto than mutual funds, equities, or ETFs.
Put together, you've got two very different assets that investors are using for related reasons. They don't look or feel like traditional equities or core bonds, and they can behave differently when headlines surprise. But investors need to consider what that means in a portfolio and how that aligns with their risk tolerance. Jay Jacobs, U.S. head of equity ETFs, frames the use case succinctly.
Two of the most common areas this year where we're seeing a lot of interest from investors is looking at gold exposure and also looking at Bitcoin exposure. Now, in a lot of ways, these are somewhat related concepts. They are looking at global monetary alternatives or assets that kind of exist outside of the traditional fiat currency system. It behaves very differently from stocks and bonds. It has a low correlation. The drivers of Bitcoin tend to be things that are not necessarily positive drivers for stocks and bonds. Bitcoin becomes more valuable if there's more economic uncertainty, worries about inflation, worries about geopolitical risk. And so it can really serve, both Bitcoin or gold can really serve a role in a portfolio as a diversifier. Within small doses of a portfolio can really help round out the shape of it.
And one big consideration for investors is that different tools could bring different risks to a portfolio.
We should also acknowledge that Bitcoin is a relatively nascent asset. So unlike gold, which has thousands of years of history, Bitcoin's only been around for a dozen plus. But also it's a volatile asset because investors are still relatively new to this asset and are understanding what it is and how it might behave in a portfolio.
In the end, the case for both gold and Bitcoin comes back to preparation. Not predicting the next economic print or the next geopolitical headline, but preparing a portfolio for different outcomes with exposures that can respond differently. For some investors, that means a measured allocation to gold for ballast. For others, it's a thoughtfully sized Bitcoin sleeve with clear rules around risk and rebalancing. For many, it may be both.
Gold has survived because it can be a diversifier in your portfolio. It gives you that ballast. And it can be tactically an opportunity for investors looking to invest in the face of slowing a growth shock or geopolitical tensions.
Thanks for listening to this special episode of The Bid. If you've enjoyed these episodes, you can go back and check out episodes 161 and 133 on Bitcoin and gold in full. The Spotify links are in the show notes. Up next, we take a look back on the investment history of AI. Make sure you subscribe to The Bid wherever you get your podcasts.